That's a whole life policy. So nobody ought to put money in a whole life policy.
Here's an alternative to whole life that Dave Ramsey usually doesn't mention. Here are 3 key differences between whole life and index universal life. Starting with the death benefit, with a whole life, usually only the death benefit will pay out. Any cash that's been accumulated will stay behind with the insurance company. This is known as a level death benefit option. With an IUL, in my experience, most of the time they're set up to pay out both the cash that's been accumulated and the death benefit. This is known as an increasing death benefit option. There's also an option known as ROP, which pays out the premiums that have been paid plus the death benefit when the person passes away. Next is growth. Most whole lives will give you a 2 to 4% guaranteed return, with some companies offering a dividend on top. However, this part is non-guaranteed. With an IUL, your growth is tied to what's called an index. The performance of the index is also non-guaranteed, but the historical performance is competitive. The minimum amount of interest you'll be credited on an index is usually between 0 to 1%, with the maximum being up to 10 to 15%. Many companies nowadays are even offering no cap on the upsides. Lastly is premium. With a whole life, you usually have to stick to a very strict schedule. You can't really skip premiums or raise or lower them too much. IUL is generally more flexible on the premiums. Whatever premium you're paying now, you can usually add more into it up to a limit, and you could even skip your premiums if you have enough cash accumulated inside your policy.